Hi there. Many UK businesses misunderstand domestic reverse charge VAT rules. Here's when the reverse charge may not apply.
Welcome to this explainer. Today, we're diving straight into the UK's domestic reverse charge VAT. But specifically, we are looking at when it actually does not apply. We're going to focus entirely on end users and intermediaries. If you're a UK company director or business owner, this is an absolutely crucial compliance topic for the 2026/27 tax year. Whether you're restructuring your supply chain or just trying to get your quarterly VAT returns right, getting this wrong can be an incredibly costly mistake. Imagine this for a moment. You're a UK director of a property development company. You've just received a massive invoice from a builder for a major commercial fit-out. You look at the bottom line, and there's absolutely no VAT charged. Instead, the invoice simply says reverse charge applies. So you pay it, file your returns, and move on. Well, suddenly, you're facing a massive unexpected HMRC compliance headache. Why? Because as the property owner who's retaining that building, the VAT actually should have been charged normally. This is a problem UK entrepreneurs commonly overlook, and it triggers severe financial penalties from HMRC because that tax liability falls entirely on you. And that's exactly the scenario we're tackling today. The insights for this explainer have been meticulously prepared by the tax advisors at Atlas Tax Advisors, or ATA for short. As a premier UK accounting firm dedicated to helping businesses master HMRC regulations, they see these exact supply chain mix-ups costing businesses thousands of pounds every single day. Here's our roadmap to keep you compliant today. We'll start with when the DRC does not apply, define exactly who an end user is, and look at the intermediary supplier exception. Then we'll cover the absolutely vital written notification rule, common pitfalls including the 5% disregard, and finish up with a summary and your next steps.
Okay, Section 1, when DRC does not apply, the basics. Before we jump into the exceptions, let's quickly establish the core mechanism. Normally, if you're dealing with standard 20% or reduced rate 5% construction services reported under the Construction Industry Scheme, the Domestic Reverse Charge, or DRC, applies. What this does is shift the VAT accounting directly to the customer. So, instead of the subcontractor charging you VAT, you, the main contractor, account for both the output and input tax on your own VAT return. HMRC introduced this to completely eradicate missing trader fraud in the construction sector. It was a sweeping change to ensure the taxman always gets paid. But, and this is a massive but that can save your administrative cash flow and really simplify your accounting, it doesn't apply to every single transaction.
Section 2. Who is an end user? The final consumer. This definition right here is your golden rule. An end user is essentially the final consumer in the supply chain. You must be VAT and CIS registered, but the absolute key is that you're receiving these services for a purpose other than making an onward supply of those exact same services. Think of a property investor carrying out extensive structural works on their own investment property to increase the rental yield, or a high street retailer bringing in contractors to fit out their newest shop. Because they aren't turning around and selling those specific construction services onto another party, they're the end of the line. They are the final consumer, which means the reverse charge mechanism stops with them.
The difference is really striking when you put it side by side in a practical scenario. A main contractor buys in scaffolding services and then supplies those exact scaffolding services onward to a property developer as part of a larger build. Because of that onward supply, the DRC applies. Now contrast that with an end user, like you, the property development director retaining the finished commercial building for your own rental portfolio. You retain the works, therefore normal VAT rules apply. The scaffolding supplier should charge you standard 20% VAT, you pay it, and you recover it normally through your standard VAT return. It's a completely different compliance route.
Moving on to Section 3, the intermediary supplier exception, connected parties. Now, supply chains are rarely simple, straightforward lines, are they? You might actually sit right in the middle as an intermediary supplier. This status is critical for businesses involved in complex tenant fit-outs or multi-tiered corporate structures. If you buy construction services and resupply them to an end user that you are directly linked to, and crucially, you do this without making material alterations to those supplies, you're treated just like an end user. That means the reverse charge doesn't apply to the services you buy from the subcontractor, nor does it apply to the services you supply onward to your connected party. It keeps your internal group billing completely free of the reverse charge headache. But to legally qualify as connected or linked in the eyes of HMRC, you have to pass one of two statutory tests. First, you might share a relevant interest in the same land. Picture a commercial landlord and a tenant. If the landlord procures construction work specifically for that tenant's commercial space, they're linked by that shared property interest. Second, you might be part of the same corporate group under Section 1161 of the Companies Act 2006. So if your property development holding company has an entirely separate procurement subsidiary handling all the builder contracts, those entities are legally linked. Intermediary status applies seamlessly here.
Section 4. The written notification rule, the magic spell. Pay close attention here, because this is the single most critical part of this entire explainer, and it's exactly where most taxpayers fail during an HMRC audit. Simply being an end user or an intermediary isn't enough on its own. The absolute necessity here is written notification. Relying on your status is actually optional. You must actively tell your supplier, in writing, about your end user status. If you don't provide this written proof, the default statutory position is absolute. Your supplier is legally obligated to apply the domestic reverse charge. They cannot simply guess your status based on your working relationship or past projects together. To ensure complete HMRC compliance, you really want to use this exact wording. We are an end user for the purposes of Section 55A VAT Act 1994 Reverse Charge for Building and Construction Services. Please issue us with a normal VAT invoice. You need to embed this directly into your initial contracts. Drop it into a formal email before works begin, or build it directly into your standard purchase order terms and conditions. Once this is formally in place, VAT is charged normally, your compliance is locked in, and you avoid massive administrative headaches later. Timing is everything here. Get this sent over before the first invoice is ever drafted. Section 5. Pitfalls and the 5% disregard. Managing risks. Did you know that snagging and remedial works don't automatically make the original contractor an end user? This is something many taxpayers first discover when reviewing their tax position after an audit. Even if you aren't charging your customer for fixing a faulty wall a year later, the subcontractor you hire to fix it is still supplying you under the original contract terms, meaning the DRC still applies. Another huge pitfall: suppliers who wrongly assume a customer's status without written evidence are completely liable. If your builder assumes you're an end user, bills you normally, but can't prove your status to HMRC, the taxman will assess them for the missing 20% VAT. It absolutely destroys supplier relationships. However, there is a very helpful, practical concession to keep in mind, and that's the 5% disregard rule. Suppose you're predominantly an end user for a major property project, but you make a tiny onward supply of those services, like recharging a small fraction of boundary wall works to an unconnected neighbor. If that specific reverse charge element is 5% or less of the total supply value, you can disregard it entirely. Normal VAT rules will apply to the whole lot. This stops minor, incidental recharges from forcing your entire £500,000 project into a complex, dual accounting reverse charge nightmare. It's a fantastic simplification tool if you know how to use it. Finally, Section 6, Summary and Next Steps, Securing Your Position. Here's what you absolutely must take away from this explainer today. First, genuine end users and linked intermediaries are entirely excluded from the DRC, allowing for normal, straightforward VAT invoicing. Second, it is entirely your responsibility as the customer to provide that formal written notification before the supply takes place. Please do not wait for the invoice to arrive on your desk. And third, keep an eye on that 5% disregard rule from mixed supplies to simplify your accounting wherever possible. Here's a professional tip. Incorrect application carries real financial costs. If you get it wrong, unraveling the VAT with your suppliers and HMRC is an absolute nightmare. So please contact Atlas Tax Advisors for personalized advice today. They can audit your contracts and ensure your statutory notifications are bulletproof. Remember, this explainer is general guidance only, so always obtain professional advice before making financial decisions. I'll leave you with this final thought. Are your standard supply chain contracts actively protecting your business's cash flow right now, or are they a ticking compliance time bomb? Thank you for joining us, and stay compliant.